As we survey the landscape of the current gold market, we see that it's been holding firm in the face of the ongoing bear market. Investors are flocking towards the safety of gold, which has driven its price upward. In a bear market, stablecoins can act as a safe harbor in the volatile sea of cryptocurrencies. Unlike traditional cryptocurrencies, which fluctuate wildly in value, stablecoins are designed to keep their value steady. Moreover, real estate is a tangible asset. You can physically see and touch it, which is false with stocks or digital assets. This tangibility can offer psychological comfort, making it a safer investment. In a world where financial landscapes can shift as quickly as a bear's mood, knowing where to safeguard your money is not just a smart move, it's a survival skill. And when the bear starts growling, it's time to turn to assets that can withstand the roar. Hello, financial adventurers. Welcome back to our channel, your trusted compass in the ever-changing world of economics and investment. Just like a sturdy lighthouse stands firm against crashing waves, great assets can shield your hard-earned money from the turbulent winds of a bear market. And in today's unpredictable financial climate, understanding these assets' power is crucial. I'm sure many of you wonder, how can we navigate through the stormy seas of summer 2023's bear market? But don't worry, because today, I will share 6 robust assets that act as your financial umbrella and offer you growth opportunities amidst these challenging times. But before we dive in, if you find our content valuable, remember to hit that like button, share this video with your friends, and subscribe to our channel for more financial insights and advice. And don't forget to ring that bell icon so you won't miss any of our future content. All right, let's jump into the world of assets and learn how to weather this bear market. First on our list, and one of the most underrated assets during a bear market, is good old-fashioned cash. Yes, you heard it right, plain and simple cash. Before you raise an eyebrow, let me explain why this is a good idea. In a bear market, prices are falling and pessimism is the order of the day. But with that comes an advantage for those holding cash. It offers increased purchasing power. This is when bargains arise, and you can pick up great investments at a discounted rate. But it's not just about what you can buy. Holding cash also provides you with a sense of security during uncertain times. While your cash won't earn you significant returns, it also won't lose value like stocks or other risky assets might in a bear market. It's like an insurance policy, providing stability when the market is anything but stable. Now, despite the advantages, it's also essential to understand the potential downsides of holding cash. One significant disadvantage is inflation. While your cash might be safe, it isn't immune to the eroding effects of inflation over time. Furthermore, keeping all your money in cash can lead to missed opportunities. Despite their risks, bear markets can offer unique opportunities for long-term investors. Staying entirely in cash could lead you to miss out on these. In conclusion, while cash is king in the short term during a bear market, you should always consider a diversified approach to protect against inflation and take advantage of potential investment opportunities. So that's it for cash. But hold on to your seats, because next we're moving into a slightly more complex yet extremely reliable realm of assets, the world of government bonds. Our second haven during a bear market, folks, is none other than government bonds. Now, for those new to this term, let me briefly explain. A government bond is a loan that you give to the government. The government promises to repay you with interest after a set period. This is why they're often considered a safer choice. Unless the government defaults, you're guaranteed to get your money back. But why are they considered a haven during a bear market? Well, when stock markets are crashing, investors tend to pull their money out of equities and look for safer investments. This is where government bonds come into play. The increased demand often leads to an increase in bond prices. Now, let's quickly glance over the current state of the bond market. With the global economy in a bearish phase, we're seeing a significant rise in demand for these bonds. However, as bond prices rise, yields, which move inversely to prices, tend to fall. So, while you can expect a safer return, don't expect a high one. It's also important to note that not all government bonds are created equal. Bonds from stable economies are generally safer but offer lower returns, while those from emerging economies can offer higher yields, but with increased risk. Like any investment, Government bonds have pros and cons, but they undoubtedly play a vital role in protecting your portfolio during bearish times. Remember, as with any asset, don't put all your eggs in one basket. Now that we've covered cash and bonds, let's dig deeper into our third asset, one that has been humankind's go-to store of value for thousands of years. Any guesses? That's right. We're talking about gold. This approach will help your viewers understand the concept of government bonds, their benefits and potential risks simply and engagingly. Hey, if you're enjoying how we're taming this bear together, give it a thumbs up. Don't let this balancing act be our little secret. Hit that subscribe button and share it with your fellow investors. Let's grow our financial circus and conquer the bear market one asset at a time. All right, we've explored cash, government bonds, and gold. Ready for a modern twist? Let's dip our toes in moving on. Let's shift our gaze to an asset that has maintained its allure for millennia, and I'm talking about the timeless and ever-radiant gold. Gold has been a symbol of wealth and a store of value since ancient times. People tend to turn to gold in times of economic uncertainty because gold maintains its intrinsic value, unlike paper currency or other assets. It doesn't rust, corrode, or decay, and there's a limited supply, all of which contribute to its status as a reliable store of value. Moreover, gold is known for its negative correlation with stocks. That means gold prices often move in the opposite direction when stock prices go down. This makes it an effective tool for hedging against market downturns. As we survey the landscape of the current gold market, we see that it's been holding firm in the face of the ongoing bear market. Investors are flocking towards the safety of gold, which has driven its price upward. However, it's also important to note that while gold is generally resilient during downturns, Investing in gold can be achieved in several ways, from buying physical gold in bars or coins to investing in gold ETFs, mutual funds, or mining company stocks. Each method has pros and cons, which we won't delve into today, but I encourage you to research and find the best method that suits your investment strategy. To wrap up, gold is a historically proven asset that can add stability and resilience to your portfolio during bear markets. However, like any other investment, it should be part of a well-diversified strategy. To the digital realm with our next asset, crypto stablecoins. Our fourth asset on the list takes us from the tangible world of gold to the exciting digital frontier of cryptocurrencies, specifically stablecoins. These are a type of cryptocurrency that is designed to maintain a stable value as they are pegged to a reserve of assets, typically a fiat currency like the US dollar. In a bear market, stablecoins can act as a safe harbor in the volatile sea of cryptocurrencies. Unlike traditional cryptocurrencies, which fluctuate wildly in value, stablecoins are designed to keep their value steady. The stability of these digital assets makes them appealing during a bear market. With their price tied to a stable reserve, they offer the potential for safety without completely exiting the cryptocurrency market. However, although stablecoins aims to provide stability, they are not without risks. It's essential to understand that while they are more stable than other cryptocurrencies, they still operate in a largely unregulated and highly volatile market. Additionally, the infrastructure of stablecoins relies heavily on the operational integrity of their issuers and the underlying technology. This means that while they offer stability in theory, in practice, they can still carry considerable risks. So, if you're considering stablecoins as an asset during a bear market, it's crucial to conduct thorough research, understand the risks involved, and seek advice from a financial advisor. Our journey through the world of assets turns back to a tangible world next. So let's move from the digital world of stablecoins to the physical world of bricks and mortar. Yes, you've guessed it, our next asset is real estate. In this part, you are offering viewers an introduction to the world of stablecoins, explaining why they can be an attractive option during a bear market, and shedding light on the potential risks involved. Navigating further, our fifth safe harbor during a bear market is real estate. Investing in properties can be a good idea during a bear market, and here's why. Firstly, real estate can provide a regular income through rent. This can be a stable source of income, especially in uncertain economic times. Secondly, real estate value typically doesn't move with stock market trends. So even in a bear market, your investment may hold its value better than other assets. Moreover, real estate is a tangible asset. You can physically see and touch it, which is false with stocks or digital assets. This tangibility can offer a psychological comfort, making it feel like a safer investment. However, like any other investment, real estate also comes with its challenges. Factors such as location, property type, market conditions, and ability to manage properties effectively can all impact your returns. Also, remember that real estate requires a significant initial investment, and it's not as easy to liquidate as stocks or bonds. So, if you're considering real estate as a place to store money during a bear market, remember to do thorough research, possibly engage with real estate professionals, and ensure it aligns with your overall investment strategy. We've covered quite a lot today, and now it's time to unveil our last asset. Brace yourselves as we dive into the world of utility stocks. Our final contender for weathering a bear market storm is utility stocks. Utility companies provide essential services like electricity, gas, and water, services people need regardless of how the economy is doing. This constant demand usually leads to stable revenues, making utility stocks a safe harbor during a bear market. Plus, many utility companies pay dividends, providing an additional income stream for investors. Despite their resilience during downturns, utility stocks aren't entirely risk-free. Regulatory changes, operational risks, and interest rate fluctuations can affect their performance. Therefore, research is key when choosing which utility stocks to invest in. There you have it, folks. 6 potential assets where you can store your money during a bear market: cash, government bonds, gold, crypto, stablecoins, real estate, and utility stocks. To summarize, navigating a bear market is no easy feat, but by understanding these 6 assets, you can better equip yourself to survive and possibly even thrive. Always remember, diversification is crucial. Don't put all your eggs in one basket. Bear markets can be challenging, but they also offer unique opportunities. These 6 assets are robust options to consider, but remember your personal risk tolerance, and that's it for today's deep dive. I hope you found this information helpful and enlightening. If you have any comments or questions about the content of this video, please leave them below. I would love to hear your thoughts and experiences. Before I sign off, like this video, share it with your fellow investors and subscribe to our channel for more financial advice. Until next time, remember, in finance, knowledge is your best asset. Stay smart and stay invested. Goodbye